Hi everyone, I'm Andy from Jurong East Investor Center.
I'm Darren from Jurong East Investor Center.
Okay, so today we're going to talk about what is
REITs.
Okay, so basically, what is REITs? REIT stands for Real Estate Investment Trust. So first of all, Real Estate Investment Trust, right? How long has it been in Singapore? Okay.
The first REIT that's IPO in Singapore is about 2002, so it's more than 16 years in Singapore already.
More than 16 years in Singapore, so it's actually not a new thing. Okay. Instead, this Real Estate Investment Trust, okay, as the name says, okay, so basically what
you are buying properties.
You are buying properties. Okay. So if you are thinking of buying a properties, what's the main difference of buying a property for yourself? Let's say you buy a condominium versus buying a REITs.
Okay, buying a property is like you have to use your own financial status to go and take a bank loan, then you make a down payment and you buy a property. How much the bank will loan you, that depend on your earning, your income, then they do the assessment, then the amount of value you can buy the properties. Okay, but for REITs is a collective way of doing buying property. That means the manager that they collect money, pool of money from all the investors together to buy a property. But by pulling all the money, they may not be sufficient to buy a property. What the next thing also, they also take a bank loans. Okay, under the name of the REITs. Then they take all collectively, all this kind of money, they will buy multiple properties.
Okay, so basically that is what we call these are the components, right?
Yes. Okay. So you can see investor pool money plus the risk manager, and the risk manager also take loan from the bank. Collectively, the risk manager have this kind of money, they will go and purchase properties.
Okay, so compare with let's say an individual, looking to buy a property versus a REITs. What is the main difference? What is the main difference between like me going to buy a property versus this type of manager?
Okay, first is capital outlay. You manage to buy a 1 million condo, you need a minimum of 200,000 cash or CPF down payment. But to buy REITs, if the cheapest REIT currently in the market, you may only need less than $300. You can buy a REIT that own maybe 20 to 30 properties.
Okay, so basically number one is the capital outlay. Okay, if for this a condominium you see on the street, okay, you need to save up 200,000, and by the time you save up the 200,000,
the price may go up further.
The price may go up further. So we see that a lot of people they are chasing, but at the end they cannot really get the property at a good price. Okay, and over here the capital outlay is also big, so that means your risk is also higher. So again,
that means your leverage also higher.
Yeah, leverage also higher. That means if you put down 200,000 cash, you are taking about 800,000 loan. So immediately when you sign the S&P agreement, sales and purchase agreement, you are in debt already. Okay, but when you buy a REITs,
you are not in debt.
You are not in debt. You are using your cash. Okay, so basically you are using cash to actually purchase an asset. And most important thing, when people buy REITs, when people buy condominium, what are they looking for?
They are looking for actually incomes. We call rental incomes. Okay, REITs we're also looking at rental income. So buying a REITs usually can get higher rental income compared to buying your own properties to get the rental income. Okay, why is this so? Maybe let me illustrate to you.
Okay, so previously we talked about this yield, right? Okay, in our previous video we talked about yield. So again, when we buy a stock, okay, the income, the yield, okay, for example, this is an OCBC case, right? OCBC pays about 0.39 cents. Okay, this is the dividend per share, and the yield is about 3.64%.
Correct.
Okay, but compare with a stock and a REITs, what is the difference between the yield? Okay, REITs is higher or lower than this kind of a dividend?
Okay, for REITs, you see people take it as more safer than buying stocks in a way. Okay, that is per perception, but it may not be correct. However, when you're buying a REITs, you expect to have a higher dividend yield compared to buying stocks. So a minimum of 5.5% yield, that's usually what I look at as a minimum entry to buy a REITs.
So 5% yield
or
is
5.5% and more. Yes.
And more. Okay, so basically, okay, when we talk about the yield, okay, when you look at the REITs, okay, for Darren's gauge, okay, the minimum, okay, it should be
5.5%.
5.5%. Anything lower usually means that.
Anything lower sometimes may mean the risk price may have been a bit too high.
Okay, it could be the price too high. That's why when the price is high, the yield will come down.
I think that when it comes to risk, we don't look at DPS, we look at DPU.
DPU.
Okay, the S change to a U.
S change to a U.
Because dividend per unit.
Okay, dividend
because it's a trust.
Okay, because it's a trust, so it's DPU, not DPS, but actually the calculation is
it's the same.
It's the same. All right.
The method is the same.
Okay, so again, I think right, if let's say sometimes the yield could be low, okay, it could also means that the dividend, dividend per unit, right, is also low.
You see, not the case. You see, when the dividend coming down, the price actually will drop.
Okay.
So the yield, that's why they can be high. So some of the yield that is very high one, actually their dividend actually is dropping because of their price coming down. People run away from their REITs.
Okay, so for you, right, what is the maximum yield you look out for current market?
Current market actually, to be reasonable, a range between 5.5 to up to maybe higher end of 7.
Okay.
7 point towards 8% is reasonable. If the REITs can give you 9%, or 8.8% or 8.5%, maybe you need to be careful of their REITs. How come they can give so high?
Why is so high, right?
Yes.
You have to ask why. Okay, so okay, so what could be the reason?
It can be the price has been dropping a lot.
Okay, so
that's why the yield becomes so high.
Price has been dropping a lot, and then the yield looks very, very attractive.
Yes.
Okay.
And because take note, the yield is based on the past trailing 12 months. It's not really the future yield. You don't know. So if the yield goes so high, there's high probability the dividend per unit for the next quarter may drop.
Okay. So again, when the dividend per unit drop, what happened to the price?
The price will usually drop also.
Why the price will drop?
Okay, because let's say for example, when I buy a REIT, I am looking at we look at 6% yield, correct? They are paying me because I expect them to paying this dividend. So when the yield drop, what does mean? That means they have problem getting a good rental income, or they may have a lot of tenant turnover that can't pay the rent.
Okay.
So that's why they collect less income and they pay us lesser. So this is a negative impact to the REITs, which indirectly also due to the price will drop.
Okay, so example, if let's say I'm a big time investor, I'm a fund manager, so if I buy these REITs, right, for dividend, and now they are cutting the dividend.
Yes.
So to me, right, I'm actually I do not like that because you're cutting my dividend, so I'm not getting what I want. I'm not reaching my objective. So in this case, the fund manager, the big players, they might actually sell away the REITs. So that will actually cause the price to
cause the price to come down.
Come down as well. Okay, so basically we like those REITs that is stable in the dividend.
Or even growing.
Yeah, even growing, definitely.
Yeah.
Okay. So when the dividend is growing, it means what?
Your yield will increase.
The yield will increase. So where does this dividend actually come from?
Okay, the dividend come from the rental income they collected from the properties.
Okay, so in what scenario, right, we will see the REITs, the price is rising, or we call the dividend is rising when, like in a scenario, in what kind of environment?
Okay, when if the market is good, because rental will, just like when you rent a shop, when it come for renewal term, the landlord may want to increase your rent.
Okay.
Yeah, the landlord may want to increase your rent. So when the landlord increase your rent, as a REIT holder, what you get? You get higher dividends.
Okay.
That's how they increase. That's how you call rental reversion.
Okay, so basically, we want to see how the investor actually get the money. Okay, so basically we have an illustration over here. Okay, so basically how does this work? Okay, how does this work?
Okay. How does a REIT work? You can see that. Take the blue line as example. When an investor give the money to a REIT manager, and the REIT manager also borrow money from the bank. Together they take this money to buy properties. After they buy a property, they become the landlord and they collect rent for all those tenants, where the tenant will pay the rental income to the REIT manager. Okay, so after the REIT manager take back the money, what they need to do? Of course, they need to pay to the bank also, because they take a loan from the bank. But what is so different between the the way they pay to the bank compare us as an individual investor when we buy property. When we buy property, we take a bank loan from the bank. We need to pay back the interest plus the capital, correct?
Okay.
That is called amortizations.
Amortization.
Okay. But for a REIT, the REIT manager only pay back the interest.
Okay.
They didn't pay back the loan. So what does that mean? They only pay a percentage, a small amount. If got interest is a smaller amount, capital is bigger amount. They only pay interest back. So that means they got big sum of rental income still with them, right? So they pay it to the investor, which is why the investor can get a good yield for REITs.
Okay.
Compared to you yourself buy your own properties, where the yield usually is lower or sometimes can be even negative.
Okay, so basically let us revise one more time. The blue line is how we invest into the REITs, and then the REITs invest into the property, and the red line is how you get your returns, your dividends.
Yes.
Okay, so for the properties, renter pay to the managers, the REITs manager pay back the interest to the bank and pay back the leftover to the investors.
Yes. So as you mentioned, there's something called payout ratio, right? So for REIT itself, because there's a rule that when the REIT manager take all the income, they pay out 90% of the income or more to the investor, it becomes tax free. So the REIT is not subjected to tax.
Okay.
So which is why there's more money given to investor, and investor will get more yield dividend in that aspect.
Okay, wow, that's fantastic. Because why? Because if we do it ourselves, we have to buy short lots or buy commercial property.
Then you need to pay income tax also.
Yeah.
But for this, it's 100% tax free.
Okay, one last question. Okay, for the investors that is watching this video. Okay, when the investors that get this dividend from the REITs, do they have to pay tax?
No, it's tax free.
Oh, it's tax free.
Everything is tax free.
Everything is tax free. So basically, why a lot of people they are falling in love with REITs, okay, is because
you take small amount of money, you can buy multiple properties in a way, and you can get higher dividend yield compared to you even buy stocks or buy your own properties.
And diversified portfolio. You don't just buy residential. You don't just buy commercial. Okay, there's a diversified portfolio, and there's professional that is managing your portfolio, the whole portfolio for you. You do not have to go and fix the toilet bowl.
When aircon pipe leak, you need to settle it yourself. Aircon problem.
Okay, so basically it's a hassle-free way of investing in property. Okay, so basically I hope that this video actually helped you to learn more about REITs and investment. Okay, so again, thank you very much for watching this, and we hope to see you in our next video.
Thank you.